We have a very special voice joining us on the show today. You may be watching him and listening to him after a very long time in business television. Moses Harding is joining us today to talk more about markets all the way from Mauritius. Moses, thanks for chatting with us and good to have you back on the show. You are in a
Thank
new
you,
role
Ajay,
and
and
away from
now.
the noise, so I'm assuming that you may be working very closely watching India and rest of the world.
Yeah, India is a key jurisdiction for us. We do a lot of things in India, and I'm happy that I'm getting back to media for my comments and opinions, although I do it on my Twitter and LinkedIn. I'm happy to be here. Thank you for the invitation, Ajay.
Talk about the global rally which is happening right now. India is also kind of latching on to it, but of course we are lagging European markets, US market, parts of Asia have also rebound. Do you see more? And now the China GDP data also came out pretty strong. What are your thoughts on this global risk on before we talk about Indian markets?
See, I think the best part in the last couple of months is that there is a stability on the monetary policy outlook from the Fed. It has been volatile. Nobody wanted to see Fed fund rate above 4%, but it went up to 5 and looking at 5.5. So that upset the rhythm post the party that we had in 2021 from QE and zero interest rate. So shifting the fund rate from 0 to 5, I think it's very abnormal and it's very difficult for the system to absorb that kind of U-turn change in dynamics. That spoils the rhythm. Now the positive takeaway is that there is a certainty that US Fed will pivot around 5/4, 5/2, and pause for a while and get into a rate cut mode, looking towards fund rate 4%. I think that's keeping the market in risk-on mode with a feel that the worst is behind. Although the best is far away, I think we are getting into a kind of a stability. From the India perspective, we have achieved stability across all parameters, be it economic stability or fiscal stability, monetary stability, and financial market stability. So I see India is a better place for investors than the West. So I think there is no need to be worried about India markets. There is no case for ecstasy or no case for despair. I think price stability is the way to go for 2023 and 2024.
Right. Moses, let's talk about India a little more in detail. At 16,850, there was, peak of pessimism. A lot of towel was being thrown in, and there was, liquidation of positions from big HNIs / family office because there was a major risk of being witnessed. That, worse may have become bad now. So the degree of negativity has gone down, not completely evaporated, but degree has reduced. Do you see this risk-on rally in India, this trade, extreme pessimism to normalize, this trade over for now, or it can get stretched on the higher side?
See, basically, India did well in 2022 on equities. It rallied when US markets declined. So that got adjusted in start of 2023. That's why we have seen the Q1 2023 moving away from 2023 high, Nifty around 18,250 and thereabout. So basically, it's a value adjustment between the US and India markets. FPI is pulled out in Q1, looking at value in US. Now they are coming back. I think this normalization is more or less achieved. I will look at that markets will stay above 2021 close, but I'm not very sure it can extend beyond the 2022 close, that is Nifty around 18,250 to 18,500. I think that's it's a 50-50 probability. But my sense is that the worst is behind, and we are looking towards the 2023 high Nifty around 18,150 to 18,500. So there is no case for being pessimistic, given that India economic dynamics are fine. We are looking at growth above 6% and fiscal consolidation towards target 4.5%. And I don't see any major issue on current account deficit or BOP. So rate markets are comfortable, and that should support the debt and equity capital markets.
Right. Moses, what are your thoughts on large financials, the private sector banks, especially where deposit growth have been very good, like HDFC. I'm not talking any specific stocks with you, but I want to understand your thought process. Large PSU versus large private sector. Where would you see a good, growth, earnings growth in the next 1 or 2 years between the two?
See, when you are positive on the economic front, you need to be positive on banking and financial services sector. But if you look at from September 2020 till now, there has been a value adjustment. PSU sector, which were available at very low valuation, have picked up steam in the last 18 months, while the heavyweights like HDFC, Kotak, which were with high multiples, they are being stable now. So the value play has been more or less done. So PSU banks have reached a kind of an appropriate valuation, while private sector, most of the private sector, except the top four, are lagging behind. I think I feel the game is for the low and mid-tier private sector banks, while the PSU banks start consolidation. So I will look at value play, and I see a banking sector very positive. But investors should look at not going overweight on heavily valued stocks and being heavy on banks that are between 25 to 50% below the all-time high. I think that's where the play is in. And fortunate for India is that the trust deficit that was there in the US is not relevant in India. So the money is not going to flow to the top end of the bracket. I think the value will get distributed across top, mid, and low end of the segment.
Moses, how are you looking at one large sector in India, but has been down in the dumps for 2-3 years, which is pharma? And it has been a global sector. It has been something which got also hit because of raw material rising and US pricing pressures. Today, we see all large pharma companies in India up 4-5%. Do you have a view on large cap pharma stocks here in India?
See, basically, I'm a bit skeptical both on pharma and IT. Number one, on the pharma is that it's a bit volatile and it's not easy for the retail investors to catch the dynamics around the pharma. It's for high-end investors who can absorb the volatility and stock. But pharma is a stable sector that's going to remain steady. On the IT side, I think as long as the West gets out of the recession, and given the outlook that rupee 2 to 2.5% annual depreciation is out of focus now, I think that's negative on IT. And pharma, I am not neither bullish or bearish, so I think I will have a neutral approach on the pharma sector and a bit of negative approach on the IT sector.
Let's move on and talk about another big sector in India, and that is also kind of very related to the interest rate cycle. In fact, there are two, real estate and autos. What are your thoughts here? Both are, if interest rates actually peak out and start going down, will the volumes on both these sectors, realty and autos, start improving? Do you like large companies there, both of them?
See, reality, it has been on the dumps for the last 10 years. But now I feel it's a recovery time for reality as the infrastructure picks up, as the wealth creation picks up in the hands of Indian consumers. We are looking for a 5 to 10 trillion GDP size. So I think the manufacturing story, infrastructure story, and the wealth creation story will get percolated down to autos, reality, and FMCG. So, but if you look at the interest rate scenario, I think the only negative I see is from the interest rate outlook, because the higher for longer theme of Fed will keep our repo rate above 5.5% for a while, for the next 2-3 years. That means the cost of funds borrowed to consume tendency will get reduced. So that will keep the real estate and auto sector little bit underweight, but it's a long-term story. I think it's a buy-on story. As beyond 2025, I look at the leapfrog momentum on the Indian economy and the demand increasing for this sector. So we have to play for a long haul. not looking at a short-term scenario. Even having said that, we are not sure of how Fed will behave after 2024. Will it go back to 1 to 3% Fed fund rate or remain 4, or if inflation stays sticky, it will go to 6%. So there are a lot of uncertainties beyond 23-24. So we are looking at a short-term outlook for 1 to 2 year outlook. And probably since there's no visibility beyond 2 years, we are not thinking more about it. But 1 to 2 year play is buy on dips. That's the story, is very clear.
All right, Moses, great chatting. Thanks so much for taking time out to chatting us today.
Thank you.
That is Moses Harding.